name is Gonçalo. I'm the co-founder and CEO of SyndicateRoom. In this very short video, I'm going to explain why valuation is so important when you decide on which early stage companies you are backing and why you really should pay attention to what the valuation of the business is before you invest. And for that, I'm just going to make a very crude assumption that you may invest into one company in a company-led equity crowdfunding platform, and let's assume that the valuation of the business is 10 million. Hasn't been negotiated by any investor, it's what the entrepreneur thinks that their company is worth. And at the same time, in parallel, I'm going to show that, for example, if you imagine that a company which value is being negotiated by an experienced business angel might be half or even a quarter of it. So let's assume that it's 5 million. Let's assume half of it, half of the value. Now this is investing in exactly the same company. The only thing that changes is the initial valuation that you invest at. With an investor-led platform it would be 5 million. In a company-led platform might be 10 million. Now let's see what happens if the company goes on, as we all expect it to be, very successful in the future and increases its value to up to, let's say, 100 million pounds. Now by increasing its value up to 100 million pounds and assuming that in both occasions you invested £1 million of this company, so you invested here £1 million. In this first case, in the company-led, after £1 million, you get 10% of the company. That means when there's an exit of 100 million, you make £10 million, or 10 times your initial investment return, which is really, really good. Sounds very exciting. If you had invested via an investor-led platform, that would mean that with the same £1 million, because the valuation is only 5 million, you'd have got 20% of the company. That means that of the 100 million pounds proceeds of the sale, you'd get 20 million or 20 times your initial investment. Remember, this is the same company, same path to success, just a different valuation at the very beginning. Now, we'll set 10 times your investment return. Sounds very, very attractive. You need to consider that all of these investments are based on a portfolio approach. And this means, let's assume that this is the only business that you've had out of a portfolio of 10 that was successful, and that these 9, you lose all your money there. Now, if you get a 10 times return, that means you just covered the portfolio. You just broke even. So you end up with the same amount of money as you had invested before. So you had invested a total of 10 million, and out of this one, you got 10 million back, and all the others, you lost your money. Going back to the investor-led model, however, what you get is 20 million pounds back. So assuming exactly the same 9 also unfortunately fail and you lose your money there, you get a 20 times return or 20 million. That means that your initial 10 million just became 20 million at the very end of this. Now remember, these are exactly the same 10 companies, assuming exactly the same 10 companies invested in, just a different valuation that you invested at. This becomes even more striking when you consider how some of the valuations are coming up as. And if you imagine this were to be a 20 million valuation that you had invested at, what that would mean is exactly the same path to success to a £100 million company, which by any measurement is a very successful company. That would mean that out of 20 million, you'd have got 5 million, because you'd have had from the very beginning 5% of the company that was worth 20 million. Now, what this means is that out of your £1 million investment, you'd have got 5 million, which is a 5 times return, which sounds very attractive indeed. However, returning to this portfolio approach, that would mean that you'd have had a 5x or £5 million back in your wallet, but that would actually mean that you'd be losing 5 million as part of your entire portfolio of 10 companies, assuming exactly the same companies and assuming that the 9 unfortunately failed. And this is why it's so important to consider valuation and what valuation you invest at. It's not enough to invest in the right companies. You need to invest at the right valuations to get a potential good financial return. I hope this diagram helped you understanding why valuation matters so much, and I hope that this information will help you make better investment decisions in the future. Thank you very much. If you liked it, there are other videos as part of this series. Thank you.